Hello and welcome to Basics and Beyond MS Excel video tutorial series. In this video, we will be talking about how to prepare a loan amortization schedule, how to calculate the installment amount, the breakup of each installment in terms of interest paid and the principal amount prepaid. In this video, we will be using some financial and date functions. If you want to learn the details of these functions, please watch our separate videos on each of these. We have prepared this structure for the loan amortization schedule. Suppose the loan amounts to 1 million rupees, borrowed at an annual rate of 10% for 10 years with 12 equal installments in a year. That means monthly installment. The borrowing date we will be keeping as 1st of January 2017. First of all, we need to calculate the total number of installments in the total life of this loan. Just multiply the tenure of the loan, which is 10 years in this case, with the yearly installment frequency. In our case, there will be 120 installments over the life of the loan. These number of installments will help us in calculating the periodic installment amount. For the installment amount, we will be using the payment function is equals to BnB. Bracket open. The payment function requires three mandatory arguments. The first one is the markup rate. In our case, it's 10%. Now, the markup rate of 10% is the annual rate. Since we will be paying installments at a frequency lower than annual, so we will be adjusting our interest rate up to our frequency. Just divide the interest rate by total number of yearly installment frequency. The second argument is total number of payments over the life of the loan, which is 120 in our case. We calculated it in previous step. Now, the present value of loan or the principal amount. Before selecting the principal amount, just put a negative sign. The negative sign will result in a positive number. Otherwise, the payment function will return a negative payment amount. The other two arguments are future value, which in our case will be 0. These square brackets shows these arguments are optional. The last argument is type. Type value could be 0 or 1. 0 value shows the installment is paid at the end of the month or end of the period, and 1 will tell the function that the installment is paid at the beginning of the function. The installment amount comes out to be 13,215. Now, just is equals to the beginning amount of this balance at the first installment payment will be the borrowed amount. The periodic installment is 13,215. Just make it a fixed reference, an absolute reference. The interest payment will be the beginning amount multiplied by the annual interest rate divided by the frequency. The ending balance will be the beginning balance minus the principal repayment. The principal repayment will be the periodic installment minus the interest payment. For the next installment, the beginning amount will be the previous installment's ending amount. The periodic installment will remain the same. The interest function, copy it down. Now just copy these till the 1/20th number. Now see, the last at the 1/20th installment, the ending balance will be 0. That means the whole loan is repaid. Now for the date of each installment, we will be using end of month function. End of month, it takes two arguments. Number one, the date, and the number of month. For 0 means it will return the last date of the month, for which the date is selected, plus add the number of days. First Feb. Now do the same for this. And just copy it down. The last installment will be paid on 1st January 2027. Now you may change these requirements as per your requirement and create your own personalized loan amortization schedule. Hope the video will help you in making your own amortization schedule. Thank you for watching our video. If you like, please subscribe to our Facebook page and YouTube channel.